Welcome back. Investors may be losing confidence in the United States, may be losing confidence. The dollar, as an example, has been dropping compared to several other currencies since mid-January, declining to the lowest level in 3 years. Chief U.S. economist for Mizuho Securities, Stephen Ricchiuto, joins me now. Stephen, it's good to have you with us. Looking at my notes, the value of the dollar has declined 9% since mid-January. 2/5 of that decline has occurred since April 1st. Why should the average American be concerned about that?
Well, the declining dollar in the environment we're dealing with, which is one where there's an inflation fear that has crept into financial markets, is really reflecting the relative inflation differentials between the U.S. and everybody else. The rest of the world is going to be experiencing increased disinflationary pressures, and the risk is that tariffs increase domestic inflationary pressures, and that's what's driving down the dollar. A weaker dollar could add to those inflationary pressures.
And when there is a declining dollar and rising yields, I've read that that's a warning sign. Why is that a warning sign?
Well, it's a warning sign that basically inflation expectations are increasing. And if inflation expectations are increasing, it suggests that the Federal Reserve is supposed to be putting on the monetary brakes. This Federal Reserve is clearly far from doing that, but it then opens up the potential for inflation to be higher than is currently priced in to the long end of rates, which would then wind up pushing long-term rates higher, and with it mortgage rates, and potentially putting additional downward pressure on equity valuations.
And for the U.S. government, this matters a great deal because we have to find mechanisms by which to finance our $37 trillion debt, do we not?
Well, we do. I think people are overplaying the deficit story in this environment. And principally, I think they're overplaying it and the amount of financing the U.S. government has to do, because there has been a reduction in household leverage that has been significant, actually about 17 of the last 18 years. And in addition to that, we've been seeing a reduction in corporate leverage going on for about a decade. So the reality is the total non-financial debt of the U.S. relative to GDP is down from where it was during COVID, from 250% down to about 225%. Now, it doesn't argue that rates should go lower, but it certainly doesn't say we're at a precipice where rates have to move appreciably higher. China is running at about 325% non-financial debt to GDP, and Japan is at 425%. So clearly, there's room to go before we run into any kind of issues.
Stephen, as I read articles about the declining dollar and fears in the bond market, I keep reading this phrase, risk premium, as it regards investing in these devices. What is that risk premium? What does that mean?
Well, the risk premium really you have to look at is two things. One is the risk of capital loss. And when you're buying certain investments, the risk of capital loss is very significant, and you have to be careful of it. There's also an inflation risk premium. And what we've been talking about here so far is the inflation risk premium. I think if people are concerned about the other kind of risk premium, the capital loss risk premium from some kind of systemic credit event, I think that's well overplayed. There is no systemic risk in this U.S. economy. We don't have an asset price bubble. We do not have an asset liability mismatch. Those are two important preconditions to assume the systemic risk. There is inflation risk, and therefore you do have a higher risk premium because inflation risk premium is part of the overall risk premium.
And Stephen, evaluate how people are trying to gauge what the future of this tariff policy under the Trump administration is actually going to be. If it is for revenue generation, as several administration officials have suggested, that means they are near permanent. If it is for negotiating leverage, that means they can be turned on or off rather rapidly. That's a difficult thing to try to assess, is it not?
Well, I think they've been pretty clear about one thing. The reciprocal tariffs are for negotiation. The baseline tariff is less of a negotiation, probably something that is more permanent, with all the carve-outs that they've already created, in particular the carve-out for auto parts, the carve-out for the U.S.-Mexican trade accord, the carve-out for some of the technology-related products. So they've already carved out some of the 10% anyway. So I think the reality is you probably assume the 10%. If you manage to negotiate with everyone all the reciprocal tariffs away, you're probably starting with 10% as the maximum, and then you're probably carving out to reduce from there.
And very quickly, Stephen, even that 10% is much higher than we have been for a long, long time.
Without a doubt, and there will be a bit of paying the piper to pay for it. The question is who pays for it at the end. The administration is convinced the suppliers will pay for it. Market participants seem to be more convinced that the consumer will pay for it. And I will tell you, when you look at the long end of the Treasury curve right now, which is moving nowhere, it's telling you the financial markets are kind of betwixt and between. They don't know which one is going to be right. They could see it playing out on either side. And the net result is they've gone nowhere in yields.
Stephen Ricchiuto, thank you very much for your time. I appreciate it.
Pleasure.